You want it? We have it. The hottest mortgage and real estate strategy broadcast in the nation. A Smarter Way Home with your host, Danielle Boote and Victor Bals. 50 years combined experience, ranked in the top 1% in the nation for home loan originations 2020. Promise to expand your knowledge, utilizing creative mortgage financing and home buying strategies. Build a bridge for a better quality of life. Get your brain cells firing for a smarter way home. And welcome to another episode of A Smarter Way Home. Mortgage and real estate strategies for our real estate professionals and consumers alike. It is 5 degrees here in the Motor City, and we had a lot of snow last night, about, 6 to 12, depending where you're at, but we got a hot show for you today. My name is Victor Bals. I am your host, and I want to introduce my co-host, my hostess with the mostest, loan officer extraordinaire, Mrs. Danielle Boote.
Good morning. How are you today, Victor?
I am very good. And I was up this morning at 4 a.m. and my neighbor hates me because I had the snowblower going. So, but hey, that's okay. But we've got a really hot show today and a very hot topic. Danielle, why don't you take it away and introduce our guest and our topic?
Yes, I am very excited to introduce to you today Sam Parker, who is the co-founder and CEO of My Credit Guy, nationwide credit repair company. And he is joining us today from sunny Florida. So he's laughing at us when we're telling him how much snow we got and what our temperatures are, because it's still 80, I know, in Cape Coral. I keep watching the Florida weather. So someday we'll be down there with you, Sam. But for now, here we are in Michigan in this cold, cold weather.
How are you, Sam?
I'm great, and thanks for having me, and good morning. And the reason I laugh is because I'm from Iowa originally, and I lived my first 30 years there, shoveling the driveway in the morning, and then when that same snow blew back over by 11 o'clock, the same shovel. So I get where you guys are coming from, and you guys are always welcome down here in Fort Myers to get away from that.
I'm watching your Facebook stuff, and when you're out on the boat with your wife and kids, and I'm just dying going. I actually showed my granddaughter your dolphin video recently that you posted when you were on like some canal, and I'm like, oh, look, Ava, look at the dolphin.
I know. I think I got to quit posting. I'm going to start losing friends.
Either that or we're just going to show up on your doorstep. Yeah. We'll be on your lanai, and your wife will be like, there's people in the backyard again, Sam. What's going on?
Well, we actually hate you right now because you're down there in sunny Florida. But anyway, Sam, tell us about credit repair. Prior to the show or pre-show here, you were saying people have to stop being the victim. And, that's going to be a topic today. Tell us a little bit about yourself, how you got in credit repair, when, why, and how.
Yeah, it's not the most glamorous story, but when I was, my plan was to wrestle in college. So I'm going to take you way back. Okay. My plan was to wrestle in college. I got hurt, so that wasn't going to work. I ended up, going into college, not really knowing exactly what I wanted. So I bounced back and forth between education and business degrees. And once my second summer of college, I was working honestly as a telemarketer, and I got recruited, and they said, hey, do you want to come and run sales and marketing for a startup financial services company? And I said, oh, that sounds great. I'm going to do that. Went to the interview. It all sounded awesome. They said that the office was going to be ready soon. So I drop out of school to go run sales and marketing, right, at this company. And I show up, and it's this little 10 by 10 room. And it just means that I'm the only telemarketer for this new credit repair company. That's what running sales and marketing meant. So I did that for a little while, saw that there was a huge need for it, saw that that people really needed this service. But unfortunately, they were one of those companies that's like so many in credit repair, where I was sitting there going, I don't know if once I sell these people, if the folks that own this company are doing right by them. So after about 9 months, I went off, and I was 20, and I started my first credit repair company. I grew that up for about 3.5 years, sold to a competitor, worked there with my wife for about 6.5 years, and then we broke away from them. moved out to Gilbert, Arizona to launch My Credit Guy. And we just hit our 7-year anniversary of My Credit Guy. And with that last year, then I moved the family down here to Fort Myers. So it's been a kind of a crazy road the last 19 years of doing this, but we really love what we've built, the team we have, and the results that we get right now.
Go ahead.
What I have found, obviously, we're talking about mortgage and real estate, and one of the biggest components of getting a borrower approved for a mortgage is their credit history. One of the things that I have found over my entire career is the lack of education nationally with consumers. Okay. Most young adults are not getting any education at home regarding how to handle finances, balancing a checkbook. Most of them are not getting it in high school. I'm not going to say all of it. Like my daughter took economics in high school and she learned some stuff. But one of the biggest issues that we have with people that want to buy a house is they don't know what to do with their credit. They don't know how to use it appropriately. And then sometimes they'll make mistakes along the way because they don't know what to do or not to do. And that will cause problems with trying to get them approved for a mortgage. I mean, you could make a boatload of money, but if you can't pay your bills on time, probably nobody's going to want to lend it to you. And it isn't even exclusive to, say, an income bracket. I've seen doctors and lawyers that don't do a real good job with paying their bills because they're too busy. And they think it's not, it's, you hate to say it, it's a little bit above them. Honestly, they should have somebody doing it for them at that point in life. But that's a huge issue that we run into. And yes, I totally agree with you, Sam. I have used other credit repair companies in the past that really don't do what they say they're going to do, or they charge too much money, or are, let's call it dishonest and leave it at that. But there's a huge need out there. And particularly for us this time of year, I think it's a very pertinent topic because January and February in our world always seems to be the time of year where we run into people that have more credit struggles. But if they start working now, we might be able to get them to where they need to be in a few months if they learn some stuff. So we thought, let's bring Sam in. Let's talk to our listeners about it and see if we can help people with the education. And if people are struggling, maybe we can potentially give them a path to, improve their future.
Yeah, absolutely. Credit education is something that for the most part doesn't happen out there, right? Like very seldom in schools. And if it does happen, it's not, what I'm not seeing is the real world application of it. They might flash up a graph of how your credit is broken down, but it's not going to get into, hey, and when you turn 24 and you have accounts that look like this, and then you're offered this loan, here's how it's going to affect your credit, right? Like we're not getting layers deep, and those layers happen really quick once you get out into the real world. So what we're trying to do is get out honestly right now to the parents, because I think that for the whole country to start to really have awareness about credit, what we need is for it to be taught at a high school level, right? Mm-hmm. And then for those folks, that generation to grow up and then be the parents that are also reinforcing it to their children that are now learning it on the way through, right? So we have some foundational problems right now that it's going to take some years to really put into our society's mind that credit is a powerful tool. You are not a victim of it, right? And so when we start teaching about credit, what we'll do is break down the credit scoring algorithm for somebody and show them all the different ways that it's like, look, if you just do what you say you're going to do, basically, right? Like credit is kind of your financial honesty score. But if you just do what you say you're going to do, when you take money from somebody and say, hey, I'm going to pay it back at this rate over this time frame, and you're honest financially, you can really turn that into a powerful weapon where you're not using up all your cash, where you leave your cash in the bank and you use someone else's money at historically low interest rates to put your family in a position that they've never been in before in the history of your family tree, right? And so, yeah, that credit education isn't happening out there for the most part. And the bigger issue is it's not being reinforced by parents.
I have a question here because I will get several calls from clients, and I call it the father syndrome. These people are coming in with no credit because their parents taught them, you don't need credit cards, pay cash, do all that. And these clients actually somewhat get very frustrated. What do you mean? I pay cash for everything and I can't get approved for a mortgage. What do you take? What's your take on that?
Well, that's also the Dave Ramsey effect. That's his horrible advice when it comes to credit and telling people that your credit score is your, what does he say? I like to pay a bunch of interest rate score is what he calls it. And it's not. It's your, again, it's your, I like to use other people's money at historically low interest rate score, right? And so that's what's happening, is that both people are being coddled by parents who are taking care of too much for too long and not letting them establish themselves as adults in this society. So it's coming back to bite them very quickly. And it's also people not wanting to utilize credit. And when you don't utilize credit, you're not building your resume. Getting a mortgage is basically the equivalent of going and trying to get your dream job, right? It's like the biggest thing that you can possibly do in that arena. And so when you don't have credit and you're going and trying to get your dream job, it's like showing up at the doorstep of that place and just being like, I really want to work here. And then saying like, okay, show us your experience, show us your degree, show us the last 5 years of your hard work, and you don't have anything to show for it. Same thing with credit. You have to show that other people have extended credit to you and that you've done a good job paying it back before anybody wants to get in line and lend you more money. So again, that's where once people get out of that victim mentality and they start to go, oh, there's some concepts here, there's some strategy here, there's some ways that I can own this, then it becomes a much more powerful tool for them.
Okay. A typical client of mine, or several clients, will come in and they'll have medical collections on there, and it's out of principle. I'm not paying that. My co-payment, my insurance company was going to pay for that, so I'm not going to do it. Little do they know it's going to destroy your credit. Many times we have these student loans that were deferred. That's a high number of clients we see where they just mark them late because they were in forbearance, or, they didn't reapply and they're getting marked late. And then, of course, we've got some bankruptcies and foreclosures. So, Sam, run us through, what is your typical client coming in? Where is their average scores, and what can they expect from your company? And then we can start breaking that down.
Yeah, absolutely. So we see a hodgepodge, right? Like we have the clients who they just had the one single item, late pay. It's very out of character. Oh my gosh, how did this happen? Maybe a student loan came out of deferment, like you said, maybe just a missed payment, all the way down to somebody who's on the brink of a bankruptcy where they have collections, charge-offs, profit and loss, but they might not qualify for that bankruptcy because they make a little too much money or they don't want to file bankruptcy, right? So either way, for the most part, the first month or so is going to start off the same. We're going to interview the client, figure out what they disagree with and why. And why that's important is because most credit repair companies, they just blanket dispute. One item fits all, one dispute fits all, throw it at the credit bureaus, not mine, take this off. And that's literally what they charge a client for and then send in, not mine, please remove this. So we'll go in and find what we believe are violations of the Fair Credit Reporting Act, the Fair Debt Collection Practices Act, and then we'll challenge the items based on those laws. Or we'll just be honest and say, hey, we just don't think this is right. You need to come back and prove it. And if the credit bureau or the creditor can't, then they have to remove it. So that part is pretty standard. And most credit repair companies hype that part up. We're going to get so much removed. We have the secret sauce, right? And that's not true. Nobody has anything other than what everybody else has, which is a method of investigating these items. And we're just pretty good at it. But where we really separate is the next part. So after you do that part, you're left with the items on the credit report that were verified. And what most credit repair companies are going to do is just keep going after those items month after month after month. But like you said, you have clients come in that have medical collections and they're on principle saying that they're going to let $768 total dollars separate them owning a home from renting on principle. And so we will try to coach them through the psychology of that, how that doesn't make sense. if it's wrong and they're saying on principle, I'm not going to pay it because my insurance company should have paid it, we'll get that off of there in that first month. But if it's still on there, we can you know, um, be very sure of it when we come to the client and say, listen, this was legally verified. So at that point, then what we would do is give the client two options. Let's say the client says, no, it is not mine. Absolutely not. Now we have FCRA and FDCPA attorneys waiting in the wings, actually based in Michigan, who will take these clients on at no cost, sue the violators that are causing the problems on their credit report, get the client damages, and get the deletion. But I want to be honest with you, that's like 3% of the time. Most of the time, the client owed that money one way or the other, right? And so then what we do is we will, on behalf of the client, start reaching out to that creditor, negotiate a settlement, negotiate a pay for deletion, negotiate something with them where it's beneficial to the client, not only financially, but credit score wise. And everything that we do is in a strategy to get them back to the closing table, qualified for a home loan with the best credit scores as quickly as possible. So again, what we'll do is we'll take them through that first filtering process. What's on here that shouldn't be on here, get it off, get it corrected. Then we move on to the debt resolution, get it to the attorney, do settlements, pay for deletions, get that thing paid so that we can move through underwriting. During the whole process, we're doing credit education and budgeting. Each one of the clients is assigned to one dedicated credit coach that walks them through the process, answers all their questions, all that good stuff. And we keep their loan officer, you guys, posted the whole time, and just kind of keep that team mentality so that everybody knows what's going on. And then we reunite you, have credit pulled, and congratulations on the home loan.
Wow. So there's certain stages here. So basically you're analyzing their original credit report, and first you're going off of and saying, okay, let's just clean this up. Let's find out what is true, what is not true. And then the next step is to potentially negotiate these collections and or get some deletions. Now, I've known where people say, I'm going to pay off that collection, and it doesn't affect their score at all. And they're thinking, well, I paid it off, or I closed my credit card. What happens there, Sam?
Yeah, well, they would be lucky if nothing happened at all. Because when you pay a collection off, you're updating what's called the date of last activity on that item. This is a data point that's on the credit report, but nobody knows what it is, what it does, and nobody would even look at it, right? But what it is it says this is how recent this activity is, and meaning is this thing active or not, right? And so when you pay a collection off from 2 years ago, 3 years ago, 5 years ago, you update the date of last activity. There's also a rating that goes on each one of these accounts, and that's not even gonna be present for the consumer to see on like an annual credit report, Credit Karma. It's only on the mortgage report, but there's a rating that goes along with it, and it's a -9 rating. When you pay a collection and you update the date of last activity, that credit scoring algorithm now sees the item as being a -9 account with today's date. It doesn't look at the balance. And so once an item goes to collection, the balance doesn't matter whether it's $10,000, $5, or $0. All it's looking at is the rating and the DLA, date of last activity. So when you pay a collection, you can almost always expect your score to drop, which is crazy.
So to put this in English, I have a collection that is 5 years old, and now I want to play good guy and clean up my books, and I go pay off that collection. I've done nothing with it for 5 years. I go pay that off. It's almost like, as of today, I pay it off. It's like a brand new collection. It hasn't been touched in 5 years. Now it's brand new activity, and it's negative activity is what is triggering.
Yep.
Interesting.
So we'll have clients that think that they're doing something good. They'll go out and they'll spend what would have been their down payment on paying off these items, only to see their credit scores drop. So think about how deflating that is, right? That's why we have to get out there and educate first, because that person's absolutely renting for another year just because they're so upset with this whole process at that point, right? And so, yeah, that happens all the time. You talked about closing out credit cards too. And that happens again. Dave Ramsey's out there telling people, close out all your accounts. When you close out a credit card, you impact multiple sections of the credit scoring algorithm. There's 5 sections, okay? One of them is length of credit history. So if I have a credit card that's been open for the last 10 years, that makes up that goes into the section that makes up 15% of my credit score. And there's no way to like get that back really quick besides having a credit card that's been open for 10 or 15 years. So when I close that account out, right, it really, for the most part, and it's not this extreme, but it's the best way to visualize it. It's like taking that entire account and all the good it's done and all the payments you made and throw it out the window. You don't get credit for them anymore. And so closing out credit cards will drop your credit scores. It'll impact your balance to limit ratio too, which makes up 30%, or credit usage, excuse me, which makes up 30% of your credit score.
Question. So the client closes out that 5 years of history. Now we have no way to measure because that history is gone. So they go open up a brand new credit card 30 days ago. We don't even have one payment to show they've made it on time. Correct?
Right.
Now, the next question is I've often heard of, putting the parents will put on their child as an authorized user on an account that they've had for 5 years with a high limit and a low balance. What effect does that have on our consumers?
It's actually a pretty decent tool to use if you're using it correctly. Meaning, if I'm a parent and I'm getting an authorized user for my kid, they might not even ever see a credit card. That, I can order them an authorized user. It's going to show that pay history on their credit report. Also, the really kind of good thing about it is that if something goes wrong, it's one phone call, or it should be one phone call to remove that authorized user account from a credit report. So it is one of the only kind of beneficial areas that's still left in the credit scoring algorithm where you can help somebody. And so again, what it is if you've had a credit card open for the last 5-10 years, I can call up my credit card company, provide the social security number and date of birth to my child, my spouse, my business partner. They'll issue them a credit card, and then on their credit report, the payment history that I've accumulated by making on-time payments or bad payments will show up on the credit report. And that's the only thing to think about when you're adding an authorized user, is that if you do something wrong on that account, then all of a sudden your kid's credit, at least in the near future until you can get that item removed, can also take a ding.
So there's credit cards, our Visas, our MasterCards, American Expresses we could put on our children as authorized user. But what about the store credit cards? The independent stores like some of these clothing stores and that, where you open up an in-store credit card. Is that the same as a major credit card?
It reports basically the same, but I don't like them. They don't have utility purpose other than that one impulse buy that day. And if they do, it means that you're shopping at that place probably too much. If you have a buckle card, like, you shouldn't. So I don't love store credit cards. They're easy to forget about. I just like a good old Visa, MasterCard, something that you can use at that store or wherever, and you're racking up airline miles for your family to take a vacation, something like that. We do also have the Credit Builder card. That is a really great tool. It's a $200 secured card, reports to all 3 credit bureaus, and shows up on credit usually within 3 weeks. So for that person that's going from no credit and needing to establish credit quick, it really is a great tool.
Explain what that is. It's a secured card. What does an individual do to start building instant credit?
Yep. So what you can do is you can put up a certain amount of money and then be issued the same in credit, meaning with this card, you put up $200, you're given a $200 credit line. And then from there on, it's not a debit card though. You can get late pays on it. You have to make the payments. It's just that you have bypassed the, we're not quite sure about you, we don't know if we want to extend you credit part by providing your own collateral, right? And so you're putting up $200. It's refundable. If you close that credit card out, you get it back. But in the meantime, you just have a $200 credit limit, and you need to treat it just like it's a $5,000 credit limit. You need to keep your utilization low, which is another section we can get into. But you need to keep your utilization nice and low. You got to make your payments on time. And if you miss a payment, you will get a late pay on a secured credit card.
You said we issue this card. How does one get this? What'd you call this card? The
The
secured
credit
card.
builder.
The credit.
Yeah.
How does one get a credit builder card?
I can send over the link to it. It is not our card. It's just a partnership that we found that they do a great job.
Okay.
And I can send over the link because our link does remove the application fee. So I'll send this over to you so that you have it, and then that way people can check it out. There's a video right when you go to the page that explains it all. So make sure that you watch the video, understand what you're doing and getting into. But it is a great tool that we've recommended to thousands of people, and the thing works like it works like it works.
So one of the things that I've seen frequently in the last couple of years is self-reported utilities. So I don't personally think that that's effective, but I have seen people that don't have a lot of credit try to report their rent. And I've also seen them report, utilities, cell phone bills, things of that nature. What's your opinion on that, Sam?
I just think for the most part, they're benign. I just think that it's giving some major institutions more information about you that's not actually impact. So to answer the question directly, it's not impacting the credit the way people think it is. At all. I've seen it all added and scores not move at all. And if they do move, maybe a handful of points, like 5 points, to where I was like, it might also be that another reporting cycle happened. And what I also have seen is underwriters asking for these things to be removed. So as of right now, I don't see it as being a great tool. I wouldn't recommend it. I think it kind of muddies up the credit report, to tell you the truth, without a lot of benefit. Now, I will eat my words, and maybe some lender comes along soon that says, actually, what we're looking for is this in more of a criteria. But as of right now, I'm just not seeing it.
I have a question here. So, because when our borrowers go get a loan, credit scores or interest rates are affected by credit scores really across the board on all the programs there. And for an example, on a conventional loan, if you're above a 740 credit score, you get the best rates, interest rates. If you're above a 760 score, you get the lowest PMI options for the monthly cost. So we have a lot of clients that come in with actually pretty decent scores, 720, 730, but they want to get a boost, to get them up another 20, 30 points. They've got good credit, but we at times, if we can get them up just a little bit, can make a huge difference over the lifetime of that loan. Do those type of people also utilize your services?
Yeah, absolutely. And they're fun to work with a lot of the time because they understand that it was a mistake that got made, and they take accountability for it. They say, what does your service cost? I understand how much money this is costing me. And then they say, that's really awesome once we are able to get that item resolved. But I wish more people did. There's not near as many people that are cognizant of it as much as, do I qualify or don't I? And then it kind of stops there in their brain. And yeah, they want to have a better credit score, but if they have a 720 and qualify, a lot of people aren't asking that question. But I also think a lot of the lenders, right, wouldn't even think to educate about something like that, because sometimes you don't want those questions asked, right? Like if you're a lender that doesn't want to take the time to cultivate that client to give them in their best deal, you wouldn't want to bring that up. So we don't deal with that near as much, but we absolutely do see clients up in that top range. And honestly, most of the time, it's just a free consultation where I say, look, pay this down, transfer this over, don't do that next month, and you're going to have your 780. It's usually a utilization issue more than a negative item issue.
Wow, very interesting here.
Well, and the thing with that, though, is timing. If somebody calls us in February and says, I'm going to buy a house this spring, and we have a couple of months to prepare, then we potentially have time to talk about credit optimization and taking somebody from a 720 to a 760. if they come to us with a purchase agreement in hand and got to close in 30 days, we don't have much time to discuss any of those things.
Well, another point there is, people will call us up and say, hey, what's your rate on a 30-year fixed? We say, well, that's a loaded question. How's your credit scores? Well, it's 720. Well, okay, your rate's this. And then they go shop around with another lender and they don't ask what their credit scores are. They say, oh, our rate's actually lower. And they go with that other lender and then get the big surprise of not knowing the credit.
Right.
So that it gets kind of a little bit crazy there at some point too. You talked cost. Average consumer. Well, run us through a scenario. What are some of the services? What are the costs? What could someone expect? And what kind of timing are you looking from someone taking? Because I always tell people, it's not if you can get a mortgage, it's when you can get a mortgage. So walk us through the cost, the different types of programs, and what services you offer.
Yeah, absolutely. So let's say that somebody only had one or two items. We're going to do a la carte pricing at usually around $200, and that's due on day 30 of the service. And one thing I want to point out is that we're the only company that I know of that truly doesn't charge upfront fees or gouge clients for a per item deletion rate, meaning the majority of the credit repair industry either charges a client when they sign up one way or the other, and it's an upfront fee. And upfront fees are against the law on credit repair. Sometimes they call it a setup fee, a paperwork filing fee, whatever. They haven't provided credit repair. The other method is to say, well, we don't charge upfront, but we only charge per deletion. The problem is we get a lot of items removed and updated. And if you do that, then all of a sudden the client has a $3,000 bill with you. So the way that we work is that if you need full credit repair, which again involves investigations, getting items removed, updated from the credit report, going through and doing settlements and pay for deletions. Most credit repair companies do not include a debt settlement or debt resolution team. One-on-one credit coaching with credit education and budgeting, helping you open and maintain new and current positive trade lines. So for that, we typically charge $399 due on day 30 for an individual or $699 for a couple. Then it would drop down to $89 per month for each additional month that's necessary, always being billed after we do the work that month and we've talked to the client about it typically by the time they're charged each month, as long as they're answering their phone. We do have ways to break that down as well. So if that's too much for a borrower, if they say, hey, listen, I'm trying to buy a smaller house, I have a smaller down payment, we'll chop it up for them. We'll do $244 day 30, $244 day 60, then down to $89 per month, and just make it a little bit more consumable. Same thing with a couple, $404 day 30, $404 day 60, then down to the 109s. Then if that's still too much, or too heavy on the front side, that would usually mean that a client is going to need a little bit longer process, right? Like if that money is like, oh my gosh, I don't know if I could do that, it typically is going to equate that they also have some things on their credit report that are going to take a little bit longer. So what we'll do is we'll let them chop it up into 4 months. So it's 4 months of 160 for an individual, 4 months of 250 for a couple. If you do the math, we never upcharge, we never add on some finance fee because they need it. We just restructure the payment out for them. And here's where we do something that most credit repair companies don't, is that we will guarantee the turn time that we quote you. So we will say, hey, listen, as long as you do the things that we are absolutely transparently laying out for you right now, pay your bills on time, possibly set funds aside for settlements and pay for deletions. We might identify a credit card that needs to be paid down to a certain threshold. As long as you do these things, within the 4 months that we're quoting you, we will have you to the 680 that you need, the 720 that you need, or else at that point we would look at issuing a refund or working for free until we finish what we started. So my point is, when usually credit repair companies have monthly fees, there's that catch too, where it's like, and that's why you're going to take 9 months. But we guarantee our turn times too. So we charge no upfront fees. We offer several different pricing options, and we guarantee our results in turn times.
Typical turn times here. A client comes to you. Are they in the program for 3 months, 4 months, 8 months? What is a typical?
3 to 5 months. So our typical is right at 4 months, right? Now, if a client comes in and they say, I want to sprint, I don't want to take 4 months. I'm gonna tell them the truth, what that's gonna take. We're gonna do one round of investigations, and then anything that's still on that credit report, you got to have funds set aside, because then we're gonna flip into settlement mode right away. In the meantime, you got to get these 2 credit cards paid down below 30%, and I want this one paid down below 10%. And then, yeah, we could have you done in 2 months. Right. And so we will just be very honest with, hey, if you want to go lightning speed, I can't drag you at lightning speed, right? Like, you are going to have to run alongside us. If you want tremendous results, you're going to have to put in tremendous action, but it will be worth it. Your family will get a home loan. So, but most people want to go at a little bit more, they say, I'm not going to sprint. I don't know how to sprint. I wouldn't want to sprint. And so you're looking at that 3, 4, 5 month range.
Question here. So I have clients that call me up, and we explain, hey, you got a medical collection there or something like that. And they actually call that creditor, right? And they try to negotiate, and they'll call me back and say, I can't get no movement. They won't negotiate. What makes them different than your company? And how can you get better action or results?
So the correct answer, the legal answer is nothing. There's nothing that I can do that a consumer can't actually do for themselves if they knew how to do it, right? If they knew the sequencing of it. So I'm going to have a log of thousands of creditors. And I know that when XYZ collection company comes up, I would never call them. We're going to get a hold of Barb. She's mean. She doesn't do settlements. I'm going to send a settlement letter to their legal department, because that's Ed and he doesn't care about anything, right? Like that sort of a thing, where it's like, we know the when, the who, the address, all of that good stuff. And we've done it. I mean, we do it thousands of times every month, where a consumer's coming in and they're trying to do this, but they're trying to do it at the expense of the biggest purchase of their life, right? And so it's not something where you want to come in and mess around when there's hundreds of thousands of dollars at stake.
Interesting. Because I get a lot of people that say, oh, I could do that. I don't want to do credit repair. I think I could do this on my own. And they get nowhere very quickly.
Or they get emotional. The thing that I have found is, they'll call the creditor and then they get mad. I'll tell people, look, if you're going to call, you better be professional. And, the bottom line is, if you defaulted on a debt, they're not going to be nice to you in many cases. And that's kind of how the collection world works. So if somebody's rude to the consumer that defaulted on the debt, and then they get their feelings hurt, it's like, well, this is not a negotiation at this point.
Right. Well, and that's what people don't realize is, and I'm saying this out of love, but you have no leverage in a lot of cases other than kindness, other than trying to be nice to the person on the other end of the phone that day, because at a collection company, a lot of times they do have the ability to go, you know what? You're nice. I'm going to take care of you. But if you call up guns blazing and you start with aggression, couple different things. First of all, you're going to get a human being on the other line that goes, you know what? Whatever right? You're going to get...
I don't get paid enough to take that kind of phone call,
Yes. And the only perk and pleasure I get is telling people like, right? Like, you're going to get that reaction. The other thing is that you can get a collection company or a creditor to dig their heels in based on legalities, meaning if you call up and you start saying, this isn't on, you shouldn't, and blah, 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 they have to protect themselves by saying because what you're saying in legal terms is, you're violating the Fair Credit Reporting Act. You're violating my rights. That's what you're telling them when you're saying that you disagree with an item. So what they have to do to protect themselves and their company is to kind of shell up and go, oh no, our position is that this is a valid debt and we're not helping you at all, because if we do give you a settlement, that could be an admission that we didn't agree that the full debt was collectible, right? And so you just don't want to go down the road of thinking that you're going to step into this credit world and just be some mercenary that goes in and takes people out. It's not going to happen.
So you have somewhat of a better bedside manner when dealing with these creditors.
It's just a process. It really is. It's knowing the what, the when, the who, and executing on it in a timely manner. I mean, there's so many things that a client doesn't think about. They don't think about disputing items correctly, right? They're going to go online to a website that is probably owned by the credit bureaus that they're disagreeing with, and they're going to file a dispute in the system that they feel that they're being wronged by. Okay, so that's their first option, is that they file online and it's a garbage little dispute that has no teeth to it. Okay, or they say, I can do this and I'm going to do it. I'm going to do it right. I'm going to do it in writing. Very quickly, they find out that there's 3 credit bureaus, meaning 3 different letters, 3 envelopes, 3 stamps, making sure that you go mail that thing, right? So there's that. Then you get 3 sets of results back. Then you need to look at those results and decide what happens. Well, what if Equifax answers one way and TransUnion and Experian answer a different way? Now you have 2 different ways that you have to go, but to 3 different credit bureaus, and then imagine that times 6 items, right? And so that's where, once a client kind of gets into it, they very quickly go, oh my God, never mind, right? And then they'll either come back to us or they won't. And that's the problem, is that when they don't, when they go, oh, never mind all of this. So, we just want to educate enough to say, hey, listen, if you want to try to go do it on your own, cool. Just know we are here for you. We're cheering for you, and we'll be here for you if it doesn't work.
So another thing that I get frequently from potential consumers is how long a collection account will stay on your credit report. So what a lot of people think is that after 10 years, that 7 or 10 years, that debt will just, $5,000 on a credit card from when you were in college, you never paid it, and now you're going to sit it out and wait for that period of time for it to drop off. Why don't you touch upon that, Sam? Because that, in our world, we know that that's not generally the case.
Yep. So this is a confusing subject, because what you're talking about is called the Statute of Limitations. There's statutes of limitations for reporting on credit, and there's statute of limitations for being legally collectible, right? Like where the company can come after you even. Okay. So to answer your question first, the statute of limitations on most items is 7 years. Okay. If it's been on, if your date of last, and that goes off the date of last activity, is it, because a lot of people will be like, well, that counts over 7 years. It's like, yeah, but you stopped paying on it like 2 years ago. Like, it doesn't matter if that is 7 years old. It's not its birthday. It's date of last activity, right?
It's birthday.
And so, yeah, it's 7 years from when it first went negative. Now, let's talk about quick what can happen in the meantime. Because yes, at 7 years, it should fall off the credit report, but that doesn't usually happen, because usually a creditor will sue you and it'll become a judgment, and then possibly even a garnishment from your paycheck, which is embarrassing, before that happens. So stick your head in the sand, hope it goes away, is not a great policy to have at all. With bankruptcies, with a Chapter 13, it's 7 years as well. With a Chapter 7, which is a total wipeout of debt, it's 10 years. And then government-backed debts, tax liens, child support, things like that, student loans, no statute of limitations on those for collection or reporting.
Okay, go back to that. Let's go back to that collection. 7-year statute of limitations. After 6 years and 10 months, can that creditor then sell that collection to somebody else, and now they report it? Now the statute starts all over again?
Good question. No, it goes off of the original statute. And so a lot of times we do have to backtrack that and find out that this debt is actually 8 years old. Yes, the new collection is only 2 years old. So that does happen. I'll tell you, it's not crazy common. Like, you don't see it a lot, but it does happen. Back like in like the 2008 kind of era where everything was a little crazy, that happened all the time. It was nuts, but it was also crazy how many collections people had back then. Everybody had collections and foreclosures.
Well, one other curveball here. Many instances, we'll see a situation where a husband and wife both had a mortgage, and now there's a divorce, and where one of the spouses was awarded the home, and so she's responsible for the payment. However, she stops making payments and destroys the other spouse's credit. What do you do in that situation? Do you come across that type of situation?
I explain to the client, and this is a mouthful, that a divorce decree does not supersede a pre-existing contract.
A promise to pay.
Yes, this is an area where divorce attorneys could do a much, much better job. It could just be on a checklist, because what needs to happen pre-divorce, I know that we're not getting along, but we might be even worse here in a little bit. What needs to happen is that any debt that you don't want on your credit report, it has to be refinanced out, because a bank doesn't care about your marital situation, because it is the exact same rules that apply if a guy and a girlfriend go in, or a guy and his buddy go in, or two strangers go in on a loan together, right? It's just that they have their hooks in two people for the money. Otherwise, they wouldn't have written the loan. They weren't going to write the loan with just the husband, right? They wrote it because of the husband and the wife, both their credit and their income. And so if you want that off your credit report, you truly have to go and get it refinanced into only one name. Otherwise, you've got to keep an eye on you got to have credit monitoring, and you got to understand that you might be on the hook for making some payments that you don't want to make to preserve your credit. And then you're going to have to go back to the court and sue for contempt of court.
Okay. I also see the situation where maybe even mom co-signed for the kid's car and the kid's now late. Is that the same situation? It's a promise to pay. You're going to destroy everybody's credit.
Yeah, it's the same situation. And that's why with this strategy if you're going to co-sign, their strategy, meaning whether you're the first person to sign on the line or the second, you're equally responsible. And that's what people think co-signing is a favor. It's not a favor. You're on the hook for 100% of the payment, not half, definitely not none, 100%. When you're signing that, what you are saying is, if that guy doesn't make the payment, I will, right? And so what you're going to do is, if you're co-signing, be the primary. Do a little side contract with whoever you're co-signing for and say, I'm helping you get this loan. You owe it to me. This is absolutely your property, but I'm obtaining the loan and you're signing on with me. That way, if you're the primary, the day that it's late, you're getting the text message, you're getting the email. It's not being hidden from you. And you're equally liable for it anyway. So it makes no difference if you're the primary or the co-borrower, right? Like legally, you owe the same amount of money. It shows up on the credit report, same mechanisms on the credit report. So be the primary.
Well, at least you know you got to beat up your kid. Hey, I just got a text. You better visit mom and dad here.
Yes.
Wow. Interesting. What else you got, Danielle? Anything?
Well, we covered a lot of ground.
Yeah. And we're just going all over the map here. Sam, what would you like to tell our consumers? Is there some other message where we haven't went? What you'd like to discuss?
Yeah, it's just the general message of empowerment through credit. There's just too many people that, because they don't understand credit, they think it's bad, right? And that's the human brain. I don't understand it, must be bad. But this is a tool that you can use to not only get ahead, but build wealth in this country if you just know how to use it. There's so many people using cash, missing out on opportunity costs just by not using their credit. And so what I would really encourage people to do is, even if you spent 10 minutes, and I'm not trying to do a shameless plug here, but go to the My Credit Guy YouTube channel. There's nothing but educational videos there. There's nothing salesy. It's just us walking you through. If you spent 10 minutes, you would be able to watch 3 videos, and better yet, have your kids, have your teenagers watch these videos so that they know going into life that credit is a good thing, that as long as you maintain it, then you're walking into a situation with your head held high. It changes the entire dynamic, where most people right now are like, I know that there's good interest rates, but would anybody work with me? That's not the way that you want to go into something that should be fun, like a home purchase. You should be proud, hold your head high. And if you just start off with education, it really is a simple thing to maintain. The one thing that I will say as a tip, we're in 2022. Every single bill can be set up on bill pay one way or the other. You can go into your credit card company, to your auto loan, whatever, online, and you can set up bill pay. If you think that you have a creditor that doesn't have bill pay, your online banking has bill pay where they will literally send checks for you. You just have to fill it out one time. And so spend 30 minutes one time and ensure that you will never get a late pay or a collection. Combine that with getting a good credit monitoring service that you check once a month. If you check it once a month, you'll always make sure that there's nothing past due, which means no 30-day late pay. So credit monitoring, keep your eye on your credit, and then set everything up on auto pay, and you can really kind of automate yourself to a 720, 740, 780 credit score.
What do you recommend, Sam, for credit monitoring? I mean, there's a lot of services out there, and I always tell my clients not to put your social security number in any app that gives you something for free.
Right.
Your credit score is not free, and you may have to make a small investment in order to properly monitor it.
I recommend IdentityIQ. It's a company that we've used for years. We did an experiment in a Facebook group that I have for lenders, and I had 4 people pull my credit at the same time just to make sure that all those scores were consistent across different bureaus. And then I pulled IdentityIQ, and it was within 5 points. Now, most of the time, a consumer report, just so you know, anybody watching or listening, that report is usually going to be 20 or 30 points lower, higher than what a mortgage lender would pull. It's a whole different thing, but it's just a different scoring algorithm. But IdentityIQ has been the closest consistently to the mortgage score. Or you got to pay $40 a month and go to myfico.com and choose like their ultimate FICO package. Otherwise, you're going to get a Vantage score. But IdentityIQ for the information is spot on, and credit score wise, it's about as close as I get. And that one it's $1 for the first month, and then it's $19 a month after that. But it's well worth it to keep your eye on.
Which is a small investment, especially with all the credit card fraud these days, and identity theft is huge.
So this IdentityIQ.com, so someone can go there to get basically a reality check, even if they're not working a lender at this point, to kind of see where they're at, and then hook up with you on if there's improvement potential, and you could build a relationship and I guess take them to the promised land?
Yeah, absolutely. So they can go there, they can pull a credit report. If they want, if they get a hold of my credit guy, we can send them a link where they'll get their first report for $1 instead of basically $20, $19. And the other thing that we can do is we do free credit reviews all day long. So we will literally sit there with you, pull your $1 credit report for you, and review it with you. And if you don't need us, we'll just make a few suggestions and wish you luck. And if you do need us, then we can draw up that game plan. But you're absolutely right. They don't need us to pull that report. They could pull that report or any report and then get a hold of my credit guy and say, hey, can you guys take a look at this? And we will look at any report, dissect it, and tell them if they need help or what they can do to help themselves.
Okay. You talked about education. I want to go back to this education because I have so many clients younger clients, that their credit is actually impeccable with the exception of all those student loans. They've never had a late payment on anything, but boom, all of a sudden we see 17, 19, 20, 90-day lates on these Navient or these other student loans. You got to see this. And I don't know how to advise clients because I don't think they can get them off. Is there a way to get them off?
Not really get them off, but you can put them in a much better situation. So you got a couple of options with student loans. And we do, if they're really messy, we have a partner that we would refer them to that helps them with all the paperwork and gets this all taken care of. But what you have when you default on student loans is, first of all, you can get into a repayment plan. That's usually a 3 to 5 month repayment plan. And then it'll basically bring it out of like collection status. And they'll a lot of times even roll it into like a new loan and close that old loan out with the late pays, all that good stuff. If you default on that repayment plan, then you're going to have to go into a full rehabilitation plan, which is usually a 9-month making those payments on time. And then again, the same thing, they'll roll it into a new, nice, clean loan, close that old one out and just kind of leave it in the past. And those late pays will haunt you for a little while, right? Like a late pay has an impact on credit up to 24 months, but at least it's not going to be ongoing on the account that you have. And sometimes sometimes they will retroactively, and we just have to look at the situation, but they will retroactively put somebody in deferment for us where we'll say, hey, listen, this deferment should have happened before these late pays, and then we can get it taken care of that way. So it's case by case, but there is always, with student loans, there's always a path to being back on the right track. They're easy to work with once you talk to them and know what to ask for.
Well, because that's what I see on these student loans. They were going to school, and boom, they were supposed to go back to repayment, but then they went back in school, and it's just like this revolving thing. And I'll see 9 different student loans on there, and they're all reporting these 90-day lates. And the students say, wait a minute, man, this ain't it. That was all supposed to be taken care of and rolled into the next semester where it's not reporting. And do you have a guy at the student loan place that you guys work with, or is there a process there that you can actually make a dent?
Yeah, it's definitely more of a process. They're really pretty, as a whole, nice to work with. The student loan people are like some of the, compared to collection companies, they're sweethearts over there. And they don't want to hurt anybody. They're not trying to hurt the students. It's just that it is what it is. They need to get their money back, and you agreed to this. And so a lot of times they're like, oh no, yeah, no, we get that. We'll work with you. So it's more of a process. It's definitely the process, knowing what to ask for, when to ask for. They'll work with you. They'll remove late pays even in some situations if you ask them correctly and the right department. And so I wouldn't say that we have our inside guy over there, but there's a group with the default department that usually wants to try to help us find an answer for the client.
Very good.
And that's going to be, I think, a slippery slope over the next couple months with the fact that we've been in forbearance for 2 years almost. And, there's millions of borrowers that haven't made payments on their student loans and will be coming out of that forbearance in May. So,
yeah, you might start having to send them more cheesecakes or something, and change your MO.
Yeah. So if you have student loans and forbearance, log in and make sure your auto pay is set up so that you're ready for this. Because right now, even the Department of Education can't handle the incoming phone calls.
Right. And if you have credit monitoring, you will see. So what you're looking for is not a late pay. What you're looking for is past due. You want to catch it before it turns into a late pay. If every month, and especially twice a month, you scroll through your credit report and you just see, is there anything in the past due column? Then you would see, oh my God, my student loans all started. I have 4 accounts that are past due. You can still get a hold of that company before you have 3 or 4 30-day late pays.
Mm-hmm.
Wow, interesting. So Sam, how does our consumer get a hold of you, both a phone number and a website? Could you let us know, please?
Yeah, absolutely. So our toll-free number is 866-726-7339. Local number is 480-999-2550. You can always email parkerteam@mycreditguy.com. And then our website is mycreditguy.com. But I will tell you also, the way that it is honestly best, especially if you're looking at getting a mortgage, is to get a hold of your favorite mortgage professionals here first. Let them know what it is that your goals are, so that way we can all work as a team together also and make sure that it's an overall plan. But you can always get that free credit review by going to mycreditguy.com.
That's excellent. Any closing words for our consumers, Sam?
Credit is power. It's there for you to use. It's an equalizer. It doesn't care how rich you are, who your mommy or daddy was. It doesn't know what color you are, what gender you are. It just knows, what do you do with your opportunities, and should we give you more based on what you've done? So if that picture that you're looking at, or that reflection in the mirror, doesn't match the person you are, it is usually just a few months of hard work away from having it look the way you want to. You just have to take that first step, and we'd love to be there for you.
You called it your financial, what was that term you used?
Resume.
It's your financial resume. Danielle, any closing words for?
Thank you so much, Sam. This was extremely informative, and hopefully our listeners that have questions will either reach out to us or to you and realize that there is hope, and you can come up with a game plan for your future, to move forward.
Okay, everybody, that's our show. That's Danielle, Boote, that's Sam, the credit guy. My name is Victor Bals, and we'll see you next time here on A Smarter Way Home.